Most people think power in Renaissance Europe belonged to kings and armies. If you wanted influence, you raised troops. If you wanted security, you built walls. If you wanted obedience, you ruled land. Power looked physical. It looked visible. It looked enforceable. But the Medici didn't rule a kingdom. They didn't command troops. They didn't conquer territory. They changed how money moved. And once that system existed, behavior reorganized itself around them, quietly, predictably, and over time, almost permanently. To understand why that mattered, you have to step into how medieval Europe actually worked. Money was physical. Gold and silver coins, heavy in the hand, limited in supply, and dangerous to transport. If a merchant wanted to trade between cities, they didn't move numbers. They moved metal. They strapped wealth to their bodies. They hired guards. They planned routes around tolls, hostile territories, and unpredictable rulers. Trade was slow, not because people lacked ambition, but because risk was constant. A single robbery could erase years of accumulated wealth. A single border dispute could strand capital indefinitely. A single political shift could turn yesterday's safe road into today's dead end. Merchants learned to be cautious, and caution limited scale. At the same time, Europe lived under a powerful moral constraint. The church condemned usury. Charging interest on loans wasn't just discouraged. It was framed as immoral, sinful, and corrosive to the soul. Lending money for profit was officially incompatible with Christian ethics. This belief wasn't symbolic. It had teeth. A merchant accused of usury could lose social standing. A banker suspected of it could be excluded from guilds, denied partnerships, or publicly shamed. In some cities, accusations carried legal penalties or confiscation risks. Reputation mattered because trust was the foundation of commerce. If people believed you were violating moral law, they stopped doing business with you. And once trust collapsed, recovery was slow, sometimes impossible. Yet the rule created pressure, because lending still happened. Merchants still needed capital to bridge time between buying and selling. Rulers still faced gaps between tax collection and immediate expenses. Wars didn't wait for harvests. Administration didn't pause for moral debates. And the church itself needed money constantly. Cathedrals weren't built with prayers alone. Bureaucracy didn't run on sermons. Diplomacy required funding. Europe needed credit. But it couldn't openly admit that it needed credit. That tension created opportunity. Because whoever found a way to supply credit without triggering moral collapse wouldn't just make money. They would decide who could act, who could expand, and who could survive financial shocks. Stay with me. At the end, I'll share a bonus tip on how the secret used by the Medici family still generates profits for traders and investors today. Fast forward to the present, and money feels abstract again. Most people no longer touch the capital that shapes their lives. They interact with numbers on screens. Decisions happen before explanations arrive. Prices move before the reasons are widely understood. That sensation isn't new. It appears whenever money changes form, when it stops being something you hold and becomes something you access. That's why the Medici matter now. They weren't just successful bankers. They were early engineers of financial abstraction. This story takes place in Florence, in late medieval Europe. The family behind it were the Medici. They began as merchants. They became bankers. They weren't nobles by origin. They didn't inherit political authority. Their influence came from designing a system that other people had to use. This is Finance Arcana. In episode 3 of this series, we examine the hidden systems that shaped money, power, and history, often long before people realized what was happening. This episode focuses on how the Medici built one of the first scalable banking machines in Europe. The core problem they faced was straightforward. Europe needed lending. but charging interest was forbidden. So bankers changed the language. They didn't call what they were doing lending. They called it exchange. Here's how the system worked in practice. Imagine a merchant in Florence. He has capital, but he needs to buy wool in Bruges. Carrying gold across borders is dangerous. Hiring guards is expensive. Every extra day on the road increases risk. He has alternatives. He could delay the trip. He could trade locally instead. He could try to partner with someone already in Bruges. Each option has costs. Delay means missed market windows. Local trade limits profits. Partnerships dilute control. So instead, he deposits his money with a banker in Florence. In return, he receives a letter, a written promise. That letter states that an affiliated banker in Bruges will pay him an equivalent amount in local currency. When the merchant arrives, he presents the letter and receives funds. No gold travels. No guards are hired. No metal crosses borders. Only paper. The banker earns money by adjusting exchange rates between cities and currencies. On paper, it's conversion. In reality, it's interest. Carefully disguised, legally defensible, and socially acceptable. This reframing mattered because it allowed credit to exist without openly violating moral rules. But the real power of the system wasn't the paperwork. It was what happened next. Deposits don't sit still. Not everyone withdraws at once. Not everyone needs liquidity at the same moment. And distance creates delay. That delay creates opportunity. A letter issued in Florence might not be redeemed for weeks, sometimes months. During that time, the banker still holds the underlying deposits. Those funds can support additional promises. Letters can be issued to other merchants. Credit can be extended elsewhere. Obligations stack before settlement occurs. This isn't a mathematical trick. It's behavioral. It works because people act at different times, in different places, with different needs. Once money becomes a promise instead of an object, scale becomes possible. And once scale is possible, it becomes inevitable. Most medieval banks were local. One city, one market, limited reach. The Medici thought differently. They didn't just open branches. They built a coordinated network. Florence connected to Rome. Rome connected to Venice. Venice connected to Milan. From there to Geneva, Bruges, and London. Each branch appeared legally separate, politically discreet, locally compliant. But operationally, they shared information. Information flowed inward. Which harvest failed? Which city faced shortages? Which ruler needed funds urgently? Which market was tightening? This information wasn't academic. It shaped decisions. Credit could be loosened where confidence was high. It could be tightened where risk was rising. Timing mattered. A merchant denied credit for a single season could collapse. A ruler delayed financing might lose a campaign. A city cut off from liquidity could spiral quickly. Credit isn't neutral. Credit is permission. When you decide who gets liquidity, you decide who can act, who can expand, who can delay payments, who can survive disruption. What the Medici actually financed. By the late 15th century, the Medici weren't just financing merchants. They were financing Europe. Their capital flowed into some of the most recognizable institutions of the Renaissance, not because they loved art or religion, but because financing visibility creates legitimacy. They financed the papacy itself. St. Peter's Basilica in Rome, the most important church in Christendom, did not rise purely on faith. It required massive, sustained funding. The Medici managed church revenues, advanced funds before taxes were collected, and smoothed cash flow across borders so construction never stalled. They financed wars. Popes and princes rarely had money when they needed it most. Campaigns required immediate liquidity, not future promises. The Medici bridged those gaps. Armies moved when Medici credit moved. They financed kings. The English crown relied on Medici banking connections to move funds between London and the continent. Monarchs didn't need permanent lenders. They needed lenders who could operate quietly, internationally, and without political entanglement. They financed cities. Florence's public works, civic projects, and administrative expenses ran through Medici-controlled financial channels. When cities needed to spend before revenues arrived, Medici credit filled the gap. And they financed culture. The Medici funded artists like Michelangelo, Botticelli, and Leonardo da Vinci. But this wasn't philanthropy. Art was political infrastructure. It reshaped public perception. When citizens walked through Florence, they didn't see bankers. They saw beauty. They saw innovation. They saw civilization. The Medici understood something subtle but powerful. If you finance what people revere, you become untouchable. Criticizing the Medici meant criticizing churches, cities, artists, and stability itself. Their balance sheet wasn't just financial, it was cultural. They were timing it. They could redirect capital quietly. They could slow flows without announcements. They could accelerate expansion where opportunity appeared. And timing is invisible until you don't have it. Now consider what happens as this system expands. Merchants begin to depend on letters of credit. Cities begin to depend on predictable flows. Rulers begin to rely on financing to bridge gaps between taxation and spending. Alternatives still exist in theory. In practice, they become costly. Carrying gold looks reckless. Operating without credit looks inefficient. Opting out looks like falling behind. The system doesn't force compliance. It makes resistance impractical. Rome intensified this effect. The church wasn't just a spiritual authority. It was an administrative machine. It collected revenues. It funded construction. It managed diplomacy. It financed politics across Europe. All of this required liquidity. The Medici became the papacy's bankers. This relationship wasn't just profitable. It was legitimizing. When you manage the church's finances, moral accusations soften, rules bend, and legitimacy spreads outward. Once the Pope trusted the Medici, kings followed. Not because they admired bankers, but because access mattered more than ideology. From the outside, the system looked conservative. Letters, ledgers, account books, respectable clerks, no armies, no revolutions. But beneath the surface, dependency grew. The more actors relied on the system, the harder it became to replace. And the larger it became, the more fragile it was to shocks. Confidence mattered. Repayment mattered. Political stability mattered. Because when systems work, they appear permanent. They become invisible until something breaks. The Medici demonstrated something profound. You don't need a crown to shape outcomes. You need to position yourself between flows that everyone depends on. They showed that money is not metal. It is trust, timing, coordination, and access, organized into systems that most people don't notice until they stop working. If Renaissance Europe was built on invisible financial machinery, what invisible systems are shaping our world right now? Here is the Finance Arcana bonus tip section. Today, information asymmetry often makes more money than effort, because the first people to see change get to price it in early. The key to profiting from information is to spend your time learning from history to see how markets move in respect to political and financial news so that you can predict the large trend movements and generate huge profits. What public legal signal do the well-connected in your area notice early that most people ignore? If you found this useful, share it with someone who enjoys understanding how systems really work. And if you want more episodes like this, subscribe to Finance Arcana. Liking and commenting on our video helps the channel more than you might expect.